Dave Ramsey might not be giving you the whole truth, but by the end of this video, we promise to give you all the facts so that you can make an informed decision and not be blindsided by something that you just didn't know or understand. Welcome back to Navigate Your Wealth. My name is Karen Stawicki. For the best advice on how to use both life insurance and annuities to create a successful retirement, make sure you subscribe to our channel and please click on the notification bell so that you can be notified every time we upload a new video. Do you understand that your IRA is a debt? Let's back up. What's the definition of a debt? The definition of a debt is something, typically money, that is owed or due. Don't you owe money on your IRA? Isn't all that money that you've accumulated and not yet paid tax on waiting to be taxed? I'm pretty sure the way for you to get it out is to pay something, typically money, that is owed or due. So your IRA is a debt. Why then would Dave Ramsey carry on about being debt-free? Why would he carry on about paying down all your debts and not include the single largest asset that most Americans today hold, which is their IRA or 401k, and the taxes that are yet to be due on that money in order to get it out? Now, I'm not saying that you should have debt or you shouldn't have debt. There's good debt and bad debt. And bad debt obviously is something that you shouldn't try and have. But your IRA is a future debt and something that maybe we should be thinking about today. Now, I know they say it is better to put as much money away today while you're in your highest earning years because you're going to be in a lower tax bracket when you retire. I've been in this business for over 40 years. And back in the 80s, I said that a lot. And back in the 80s, when tax brackets were as high as 70%, that may have been true. My clients that were deferring at 60, 70% back then are pulling it out at 25 and 30% today. Now, they're still complaining, but given the alternative, they made out well, right? But you're putting money away today. The top marginal bracket is in the 30s. When you go to pull that money out, how do you know that you're going to be in a lower tax bracket? That's a question that you have to consider. It's very probable, if not for certain, that tax rates will go up in the future. Something else I want you to consider, especially if you're in your early working years. You are not in your highest earning years. I have confidence in you even if you don't have confidence in yourself. You're going to make more money in years to come. So how do we know that you're in the highest tax bracket today? Leave a comment in the section below if you've ever considered your IRA or 401k to be a debt. Also, after this video, check out the link for our next video called How Can I Get Tax-Free Income? To learn other creative ways to not have IRA tax debt in retirement. The details are in the description below. You may be wondering what you can do to pay less taxes or at the very minimum not have this big debt looming over your head when you retire. We've mentioned them in previous videos, but I think it's worth repeating again now. There are actually a couple of things that you can do. First of all, if you're working and you're contributing to your 401k, you should never consider your 401k the sum total of your retirement planning strategies. If you get a company match, it's a no-brainer, right? The first rule of financial planning is take the free money. So whatever you have to contribute to get that match, you need to be doing that. But beyond that, and you should be saving more than that, you should look at some after-tax options, something that will allow you to have that money grow tax-deferred, but now on distribution come to you tax-free. The second thing is if you're close to retirement or already retired and you have a big IRA or you have a big 401k, you should consider doing a Roth IRA conversion or a super Roth IRA conversion. Now, I understand that in either case, that means taking your retirement monies, paying tax, and then putting it into this new vehicle. And paying tax is never fun. You can run, but you can't hide. The IRS is a joint partner on those accounts with you. They're going to get theirs. Here's the question you need to be asking yourself. Does it make more sense for me to get it out over a couple of years and be done with it, or to pay it over a longer period of time? I'm going to tell you something. Shorter will give the IRS less. Longer will give the IRS more. We call this the total tax burden. You know we love to finish our videos with a story, something that you can perhaps relate to make this all make sense. Well, we had a client who had done a tremendous job of saving and accumulating all the years that he was working. And when he retired, we sat down to talk about what the distribution strategy was going to be from this very large IRA. When he understood that it was going to be taxable, please don't be surprised by that, it's going to be taxable. He didn't want to take any money out because, as he explained, he had a pension and he was going to soon be getting Social Security. So he had more than enough income to live comfortably in retirement. I tried to explain to him what was going to happen, but he would not hear of it. So, roll the clock forward, 10.5 years later, when he turned 70.5, which for him was the required minimum distribution age. Today it's 72, but for him it was 70.5. The good news was his accounts had more than doubled. That's good news, right? The bad news was his life expectancy was 10.5 years shorter. And that, unfortunately, is what the RMD is calculated on. It's based on your life expectancy. So, up to that point, he had been in a very manageable tax bracket. Unfortunately, once he realized what the RMD calculation against his current IRA balance meant in terms of distribution, he about had a heart attack. He could not believe that that distribution would actually push him up 2 tax brackets. It can happen. It's a sad, sad thing, but it can actually happen. Now here's what you need to understand. He, of course, said, I don't want to take the money, but that's not your option. You know how when you take money before 59.5, they have this thing called an early distribution penalty, and it's 10%? Well, when you hit RMD age, which for him was 70.5, for most people today is 72, if you do not take the required distribution, the penalty is 50%. You heard me, 50%. So you need to make sure that you're managing this and not letting this catch you by surprise. If you'd like to learn how to manage your future distributions and not let this happen to you, click on the link below to apply to become our client. Also, if you enjoyed this video and learned something from it, please give us a thumbs up and make sure you share it with a friend. Thank you so much for watching, and remember, as we always say, if what you thought to be true turned out not to be, when would you want to know it?